In part B, calculate the market value of the investment in Stationery Suppliers Limited. And the calculation is for 6 marks. So if we go back to the information provided in the scenario, in note 4, you were told that Bulletin holds 100,000 shares in Stationery Suppliers Limited. Dividends are expected to grow by 12% for the next 2 years and then by 10% indefinitely. The shareholders' required rate of return is 15%. All right, so we have the shareholders' required rate of return, which is the cost of equity. We also have the dividend income on the statement of profit or loss and other comprehensive income. So we have enough information over here, and sorry, we also have the growth rate. We know that they are going to grow, or dividends are going to grow by 12% for the next 2 years and then by 10% indefinitely. So we've got the growth rate as well. So we have enough information to perform this valuation using Gordon's dividend growth model. So that's the first thing that you need to establish. How are you actually going to perform the valuation? Well, based on the information provided, we are going to perform the valuation using Gordon's dividend growth model. So if we are trying to calculate the value, we take the future expected dividend and we divide by the cost of equity less growth. That will give us the market value of the investment. But the problem that we are facing, and what makes the calculation a little bit more difficult, is you can only use this formula if you have consistent growth in perpetuity. Now, we don't have consistent growth in perpetuity. Dividends are going to grow by 12% for the next 2 years and then by 10% indefinitely. So when they start growing by 10% indefinitely, then we have consistent growth in perpetuity, and then we can use this formula over here. However, for the first 2 years where we don't have consistent growth in perpetuity, we need to look at those dividends separately. So let's have a look at this calculation. We have done a very similar example in the lecture, so you shouldn't have struggled with this. So we are currently sitting in 20x6. That is the current financial year. Then I have 2 separate years. I have 20x7 and 20x8 separately. The reason why I have them separately is because for the next 2 years, dividends are going to grow by 12% per annum. And I have to deal with those 2 years separately. After that, we'll have a perpetuity calculation. So that's how you know how many columns to include in your calculation over here. It's also important to note we won't include any cash flows for the 20x6 year. Because remember, when you are performing a valuation, the value of something is always the present value of your future cash flows. So the 20x6 year is the current financial year. So that's definitely not a future cash flow. We know during the 20x6 financial year, they received a dividend of 250,000 Rand. That is a current cash flow. It is not a future cash flow. So we won't be including that in our calculation. We only include future cash flows in the calculation. Remember, the value is always the present value of future cash flows. Whenever you are performing a valuation. So, in 20x6, we won't include any cash flows in this column, so the total will be 0. We can easily calculate the dividend in 20x7 because we have the dividend in 20x6 and we know that it's going to increase or grow by 12% for the next 2 years. So the dividend in 20x7 will be 280,000 Rand. We can calculate the dividend for 20x8 applying exactly the same logic because it will increase by 12% again. So for the two periods where you don't have consistent growth in perpetuity, you deal with those dividends separately. Calculate the dividend for 20x7, calculate the dividend for 20x8, put them in the correct columns. Then after that, we have consistent growth in perpetuity, and we can then use the perpetuity calculation or the perpetuity formula. Right, so I'm just going to perform a separate calculation over here because I haven't left myself enough space. All right, so the present value is the future expected dividend divided by the cost of equity less growth. So what dividend are we including in the calculation over here? Guys, we have already separately dealt with the dividend for 20x7 and the dividend for 20x8. So the next dividend is the dividend for 20x9. So how are we going to calculate the dividend for 20x9? It's going to increase by 10%. So take the dividend from 20x8 and increase that by 10% to get the dividend for 20x9. We then need to divide that by the cost of equity less growth. The cost of equity is 15%, and the growth rate is 10% in perpetuity. So that gives us an answer there of 6,899,200. Now, what do we do with everything that we've calculated over here? What is the logic behind this calculation? Remember, the formula is always D1 divided by the cost of equity less growth. And D1 is always the future expected dividend. D0 would be the current dividend. However, we know, we've already addressed this, that when we are trying to value something, we don't include the current dividend or the current cash flow in our calculation, because the value is always the present value of our future cash flows. So that's the logic behind why we always include D1 in the calculation over here and not D0. You don't want the current dividend, we want the future expected dividend. So that's what we include, and that's normally the logic that we follow. But please remember, if you include the future expected dividend in your calculation over here, that doesn't give you the value 1 year from now, that gives you the value today. So you include next year's dividend in the calculation, but that doesn't give you the value next year, that gives you the present value, which is the value today. So you can see this jumps back 1 year. And I say that all the time. Make sure you understand what I mean when I say this jumps back 1 year. If I include next year's dividend in the calculation, it's going to give me the present value or the value of the investment today. It jumps back 1 year. It does not give me the value next year. It gives me the value today. When I use next year's dividend, it gives me the value today. It's very important that you understand that logic, because here we are using the dividend for 20x9, and we follow the same logic. It jumps back 1 year, which means the present value that I've calculated over here is the present value in 20x8. This can't jump back 3 years and give me the value in 20x6. That's not how this formula works. If I include next year's dividend in the calculation, it jumps back 1 year and it gives me the value today. So if I include the dividend for 20x9 in the calculation, it's going to jump back 1 year and give me the value in 20x8. So we are going to add this to our 20x8 cash flows. We can then total all of our cash flows. and wrap up this calculation. So we are going to include these cash flows in our financial calculator. Make sure that you always show your calculator steps. Don't just write down an answer. So we'll include all of those cash flows. Then the discount rate that we are using to calculate the net present value is the cost of equity, because we are using Gordon's dividend growth model, and when we use Gordon's dividend growth model, we use the cost of equity as our discount rate. So the discount rate is 15%, so you input that as I, it is the cost of equity, and you solve for the net present value, and that is going to give you the market value of the investment. Now, please make sure that you understand the logic behind this calculation. Remember, we said we calculate the value by taking the present value, or calculating the present value of the future cash flows. So we've estimated all of the future cash flows. In 20x7, Bulletin will receive a dividend of 280,000 Rand. In 20x8, they'll receive a dividend of 313,600 Rand. Then after that, dividends are going to increase by 10% per annum, and that's going to continue in perpetuity, so indefinitely, forever. The dividend will keep increasing by 10% per annum, and they will keep receiving that indefinitely. Obviously, until they actually sell the investment, but if we haven't been given information about the fact that they want to sell the investment, we can't take that into account in our calculations. We need to assume that they're going to receive those dividends in perpetuity. So this number over here takes that into account. This number takes into account the dividend that they are going to receive in 20x9 and all of the dividends that they are going to receive after that. All of that has been present valued to give us a value in 20x8. So if we want the value of this investment, it's the present value of the future cash flows. First, you estimate what the future cash flows are. There's all of your future cash flows. This has already been present valued, but it doesn't give us the value today in 20x6. Remember, it gives us the value in 20x8 because it only jumps back 1 year. So then what we do is we input all of these cash flows, which are all of the future cash flows, into our financial calculator, and using the cost of equity as our discount rate, because we are using Gordon's dividend growth model, and with Gordon's dividend growth model, you always use the cost of equity as your discount rate. So using that as our discount rate, we calculate the net present value, or in other words, the present value. So that gives us the value of the investment. All we've done is we've present valued all of the dividends that Bulletin expects to receive from this investment in the future. What is the present value of all of those dividends? That gives us the market value of this investment. All right, and that then answers part B of the required.